Nothing so far. However, I realize that I can't change or have my I can't change the position here. So I gotta change the position in my cam and chat. But anywho, let's go on to where I left off around the area. Along with me also seeing if me actually moving the preview screen for the camera actually for its inner flick screen. Because I actually did saw some weird flickering that actually happened, so let's see if that happens again. Well, anyhow, I still got a lot to cover. Anyhow, let's talk more about short selling and what way. What's what ideal conditions? Remember I didn't cover that. However, cost of short selling. Okay. Yeah, wrong timing. Additional risk factors. Didn't cover that much. Rhythm column list, that's pretty important, but did I cover most of it? Short selling is a hitch. I should just go down to. Yeah, just additional risks to short selling. So let me try to properly position it. Okay, and let me see my preview if everything's good and its end. That looks right okay. Well, I wonder if my bottle. Oh yeah. Last thing. Okay, is this suitable? This is somewhat suitable. It was like the whole time I'm just trying to adjust everything in the setup because I'm always worried about technical issues on a daily basis. Not entirely because of streaming, but because of so many other things. Well, anyhow, let's go on with the show. Additional risks to short selling. Besides the previously mentioned risk of losing money on a trade from a stock price rising, short selling has additional risks that investors should consider. Shorting used borrowed money. Shorting is known as margin trading. So, yeah, it's real definition. It uses margin trading. So, what is margin? Margin is the money borrowed from a brokerage firm to purchase an investment. Is the difference between the total value of securities held in an investor's account and a loan amount from a broker. So, there's no that margin. Yeah, it is different because this money borrowed is from a firm to make an investment, so for a sole purpose. And difference from actually borrowing it from a friend, family member, such like that. Anywho, there's a video explaining everything, but I can't play it, so shoot. Okay, understand margin. Margin refers to the amount of equity as an investor has it's in their brokerage account. To margin, or to buy on margin, means to use borrowed money from a broker to purchase securities, which would be stocks in this account. Example, you must have a margin account to do so rather than a standard brokerage account. Yeah, because brokerage account you can actually insert money. However, margin account you can't really insert any money. Just the money you borrowed. Now let's go to key takeaways. Margin is the money bought from a broker to purchase an investment, and is the difference between the total value of investment and the loan amount. So investment money is not really a loan. Margin trading refers to the practice of using borrowed funds from a broker to trade a financial asset, which forms to collateral for the loan from a broker. It's around the same definition. Okay, let me skim through these. Well, we got definition. So shorting is known as margin trading. So when short selling, you open a margin account, which allows you to borrow money from the brokerage firm using your investment as collateral. Just as when you go along on margin, it's easy for losses to get out of hand because you must meet the minimum maintenance requirement at 25%. If your account slips below this, you'll be subject to a margin call and forced to put in more cash or liquidate your position. Wrongo timing. Even though a company is overvalued, it could conceivably take a while for its stock price to decline. In the meantime, you are vulnerable to interest, margin calls, and being called away. There's a short squeeze if a stock is actively shorted with a high short. Come on, account. Come on, website. With a high short float and days to cover ratio, it is also at risk of experiencing a short squeeze. So that's difference between short selling. So let's go up here. Short selling, yeah, short selling and short squeeze, because those are the two big things that are in people's mind and the zeitgeist of today's pop culture. What a short squeeze and short selling is. So let's go with short squeeze. What is a short squeeze? Let me hydrate. A short squeeze occurs when a stock or other asset jumps sharply higher, forcing traders who have bet that its price would fall to buy it in order to forestall even greater losses. The scramble to buy only adds to the upward pressure on a stock's price. Key takeaways. A short squeeze escalates a stock's price rise as short sellers bail out to cut their losses. Contrarian investors try to anticipate a short squeeze and buy stocks that demonstrate a strong short interest. Both short sellers and contrarians are making risky moves. A wise investor has additional reasons for shorting or buying that stock. So, as you can see, this was updated January 28, 2021. This was a few days ago. Let me look at Lomapo. Yeah, that would be Thursday. So last Thursday. Same as freaking short selling, and is even reviewed by Gordon Scott. Let me also check on graded. Yeah, this one's reviewed by Gordon Scott, but But short selling is by James Chen versus short squeeze, which is by Corey Mitchell. Okie dokie. So yeah, let's go to the takeaways. Yeah, we're in this, we're in that. Now, short sellers borrow shares of an asset that has believed will drop in price in order to buy them after they fall. Okay. Huh. Even has a warning. Beginning in January 2021, a series of short squeeze. Yeah, GME and AMC. Ooh. Let me say this in a more nasally voice. Warning. Beginning in January 2021, a series of short squeezes occurred in several different stocks, including GameStop Core, GME, and AMC Entertainment Holdings EIC, AMC. Following concerted efforts for retail traders on Reddit to drive up the price of the stocks, there is. Ugh. Yeah, okay. Okay. This resulted in large price spikes as short sellers were forced to cover their short positions for substantial losses. These volatile price movements were not driven by fundamental factors or news about the companies. Investors should be particularly cautious when considering trading stocks during short squeezes. Oh. Oh my god, my voice is a little bit killing me. Anyhow, understanding the short squeeze. The flight of short sellers and their impact on the stock's price is known as a short squeeze. Short sellers are being squeezed out of their positions, usually as a loss. Short sellers zero in on a stock that they think is overvalued by the market. For example, Tesla captured the enthusiasm of many investors with its innovative approach to producing and marketing electric vehicles. Investors bet heavily on its potential. Short sellers bet heavily on its failure. In early 2020, Tesla was the most shorted stock on the US exchanges, with more than 18% of its outstanding stock in short positions. In late 2019 through early 2020, Tesla stock soared by 400%. Short sellers got hammered, collectively losing about $8 billion. In early March 2020, Tesla stock finally fell, along with most others during a market downturn. Short sellers made about $50 billion in a sell-off that lasted a few days. Short squeeze. Where short squeezes happen, as noted. Why short squeezes happen? As noted, short sellers open positions on stocks that they believe will decline in price. However sound their reasoning is, it can be appended by a positive news story, a product announcement, or an earnings beat that excites the interest of buyers. Their turnaround in the stock's fortunes may prove to be temporary, but if it's not, the short seller can face runaway losses as the expiration date on their positions approaches. They generally opt to sell out immediately, even if it means taking a substantial loss. 18%, the percentage of a Tesla stock that was represented short interest in late 2019. Its stock price quadrupled and short sellers lost billions. That's where short squeeze comes in. Every buying transaction by a short seller sends the price higher, forcing another short seller to buy. Yeah, it sounds more of a playing chicken game. And also trying to see who can actually compete versus another. Hence the word squeeze. Squeezing the person to sell or buy. How to measure short interest. Two measures useful in identifying stocks at risk of a short squeeze are short interest and the short interest ratio. So I'm just going to briefly go with short interest ratio. It's just going to be a math formula. So short interest definition uses What is short interest? Again, by Corey Mitchell. Updated January 28th, so it looks like investigators had to update it, anything related just to short selling and short squeeze in general. Short interest is the number of shares that have been sold short but has not yet been covered or closed out. Short interest, which can be expressed as a number of percentages, is an indicator of market settlement. Market settlement. Oh, they also have the bearish and bullish. But I'll read more into that if it actually covers it in short selling, its page itself. But for market settlement, let me briefly talk about it. So that's something I don't know much. Market settlement. Oh, from Jen Smith this time. What is market settlement? Market settlement refers to the overall attitude of investors toward a particular security or financial market. Is the feeling of tone of a market, or is crowd psychologically as reviewed through the activity and price movement of securities traded in the market? Yeah, I understand that. But what I'm still confused is just how people like to live around with settlements that is probably unsatisfied, or it's just all jolly and good. But then that's just also me just wondering how it is judged by others who want to go against the general feeling that people have been experiencing. So now on to key takeaways. Market sentiment versus the overall consensus about the stock or the stock market as a whole. Okay, gotcha. Yeah, and it just talks about bearish and bullish attitudes, which that's the way I see it. Attitudes. Well, anyhow, that's what we've been talking about. Short squeeze in general. There's a lot about it, but it is part of the conversation. Short selling and short squeeze. So here, if a stock is actively shorted with a high short float and days to cover ratio, it is also a risk of experiencing a short squeeze. A short squeeze happens when a stock begins to rise and short sellers cover their trades by buying their short positions back. This buying can turn into a feedback loop because it has to seek demands and such like that. Demand for the shares attracts more buyers, which pushes the stock higher, causing even more short sellers to buy back or cover their position. Either then they have to buy more stocks or less so, which can create a vicious cycle. Yep, I read through here. Yeah, these policy press. Yeah, we understand that. They pretty much put it on Reddit, the website in general, instead of just Wall Street bets. But even Reddit doesn't mind them being stated that it's our website that is doing it. So it wears badge of honor for all Redditors. Regulatory risks. Regulators. Yeah, regulatory risks and regulators sound different, but that's the same word. Regulators may sometimes impose bans on short sales in a specific sector or even in the broad market to avoid panic and unwarranted selling pressure. Such actions can cause a sudden spike in stock prices, forcing the short seller to cover short positions at huge losses. Yeah, that's the thing with regulatory risks. They can happen, they have happened, and it sucks for whatever end you're experiencing, even if it means regulatory risk is some publicly traded stock apps not allowing people to invest, and they could call it as regulating the exchange, which, I mean, yeah. To avoid panic or unwanted selling pressure, sort of can create more of it, depending on how you can handle it, especially with how much people you actually offend. Well, that could make it. Going against the trend, history has shown that in general, stocks have an upward drift over the long run. Most stocks appreciate in price for that matter, even if a company barely improves over the years. Inflation or the rate of price increase in the economy should drive its stock price up somewhat. What this means is that shorting is betting against the overall direction of the market. And that is the perfect reason why it is so beneficial for people to invest stocks into something and let it sit there, because over time the market has shown that it will keep on rising and rising. Even if it's a slow process, you will make up the money and you will make a profit. But this perfectly explains it, that inflation is the key factor. Inflation is the reason why the value of a dollar I have in my wallet can be not worth what it is today than what it will be in the next 2 years. Same thing with the dollar and how much it was worth a few years ago compared to now, where now it's less worthy. But with stocks, you always have it there, and it could be safe. I mean, that's also the thing about the idea of money investments, like what is it, RIA, 401ks, IRAs, all that, because inflation is a bitch, and it is something a lot of people have to get slightly bitten and hurt you, especially in your wallet. Your wallet is getting bitten little by little on its value. So with stocks, at least it would sit in that value and would even grow a bit. Rising stocks is not because of you getting money, but able to let the money hold still and be as valuable as it was when you purchased it versus in the future if you had it physically. There's a reason why having money safe in the bed cannot be a good idea, and it's not just security. Let me read this again. Over the long run, most stocks appreciate in price. For that matter, even if the company barely improves over the years, inflation or the rate of price increased in the economy should drive its stock price up somewhat. What this means is that shorting is betting against the overall direction of the market. The advantage. Trend and stuff, it's the way they think about it. I mean, that's the same thing with saying, like, having securities in the market, which really could just be money, because a lot of people will put in money. But if you're working in an organization like a hedge firm, you could borrow that money. Organizations, governments, people, yeah. Costs of short selling. Unlike buying and holding stocks or investments, short selling involves significant costs in addition to usual trading commissions that have to be paid to brokers. Some of the costs include, we're all going here. So this is the cost of short selling. Now let's go with margin interest. Margin interest can be a significant expense when trading stocks on margin, since short sales can only be made via margin accounts. The interest payable on short trades can add up over time, especially if short positions are kept open over an extended period. Now let's get on to stock borrowing costs. Shares that are difficult to borrow because of high short interest, limited flow, or any other reason, have hard to borrow fees that can be quite substantial. Now let's go with on to hard and borrow. I also saw the time, and yeah, I'm not gonna get able to finish it because it seems like I'm learning quite a lot. Um, there's still a lot I want to cover, so I figured I might as well just talk more about it, especially with the short squeeze part because it's something important. Hard to borrow list. What is a hard to borrow list? A hard to borrow list is an inventory record used by brokerages to indicate what stocks are difficult to borrow for short sale transactions. A brokerage firm's hard to borrow list provides an up to date catalog of stocks that can not easily be borrowed for use as a short sale. Gotcha. Now let's go with key takeaways. Short sellers rely on brokers to have stock shares available to borrow. They have to rely on brokers, these sellers. If the broker has very few shares of a stock available, then that stock is placed on the hard to borrow list. Stocks in the hard to borrow list may not be allowed to short. So, in this sense, let's go with the average Joe with apps because apps pretty much work with brokers. That's how people are able to put money in stocks because they're going through a broker. But in this case, it's a broker using an entire application service. And in that case, then you go to the list of whatever you want to put in for borrowing, for lending, and stuff like that. You can be accepted or not accepted to certain lists when you buy certain things. That's the broad um, way a person who doesn't know entirely everything can put. So I'm just gonna put it like that. Alright. Now let's go to the fee. Is based on an annualized rate that can range from a small fraction of a percent to more than 100% of the value of a short trade and is prorated for the number of days that the short trade is open. As the hard to borrow rate can fluctuate substantially from day to day and even on an intraday basis, the extra dollar amount of the fee may not be known in advance. Yep. The fee is usually assessed by the broker dealer to the client's account either at the month end or up upon closing of the short trade. And if it's quite large, and it can be a big dent in the profitability of a short trade or exacerbate losses in it. So even brokerages like these application services can have their own way of how they run things, even if you don't necessarily agree. It's something a lot of brokers do look at. So yeah, dividends and other payments. Okay, the short seller is responsible for making dividend payments on the shorted stock in the entirety from whom the stock has been borrowed. So this goes with trying to get interest, which would be dividends, because you're getting some money out of just holding a stock in order to incentivize people to still stick with that stock for security of the company. And these are from the companies giving it to sellers and brokers. The short seller is also on the hook for making payments on the account for other events associated with the shorted stock, such as share splits, spinoffs, and bonus share issues, all of which are unpredictable events. These will be negativities with short selling where you can actually still have to pay larger fees due to something that they don't want. So there's gonna be punishments and stuff like that. Now let's go with short selling metrics. Let me briefly go over it because it's metric. Two metrics used to track short selling activity on shorts are short interest ratio, CRI. Okay, and that's short interest and the volume ratio. No, we don't have to follow that. Okay, let's go to the other one. Ideal conditions for short selling. Timing is crucial when it comes to to short selling. Stocks typically decline much faster than they advance. A sizable gain in the stock may be wiped out in a matter of days or weeks on the earnings miss or other bearish development. The short seller thus has the short trade to near perfection. Entering the trade too late may result in huge opportunity cost in terms of lost profits. Okay, let me finish this. Since a major part of the stock's decline may already have occurred, on the other hand, entering the trade too early make it difficult to hold it on the short position in light of the cost and involvement potential losses, which would skyrocket the stock increases rapidly. Yep, timing is always a thing with almost anything. And with that, that's the reason why stocks always update every single time, and you have people that go very, very ape shit if it suddenly an app tends to crash or delay, because that could mean a huge loss or gain. That occurred with Robinhood before, and why they even got sued like months and months ago because they had that freaking terrible thing that happened. Anywho, I'll get back to this next time. Other than that, so long.